Hello everyone and welcome back to the Outpsoken Market Global. Leandro Guerra is speaking, and today we need to talk about the real-world pitfalls of hidden Markov models and exactly how to fix them. Look, these models are for sure a powerful tool for spotting market regimes, but let's cut through the hype. If you blindly trust the math, these models will look flawless in a backtest, but they will absolutely destroy your account in live trading. And here are the core problems and exactly how we fix them. The absolute most dangerous flaw with these models is that they love to rewrite history. When you run a standard model, it uses new data to change its mind about the past as well. It's not just about what happened months ago, it messes as well with your immediate trades. If you take an action today based on today's reading, the moment you get a new data point tomorrow, for example, the model can look back and completely change its mind about what today was. What you thought was a rock-solid buy signal, for example, suddenly becomes a transitional phase when you look back at it tomorrow. That gives you a beautiful backtest, but it's a total nightmare for live trading because you can't back, of course, in time and cancel a trade you already executed. And to fix this, you have to use what we call online filtering instead of smoothing algorithms. Filtering forces the model to calculate probabilities sequentially, using only the data available up to that exact moment. You must strictly lock in your trading decisions at the time of execution, so the model is forced to live with the past signals and can never alter them. And the second major issue, of course, is overfitting, where the model memorizes past noise and becomes incredibly fragile. Now, a lot of people will tell you to use walk-forward optimization to solve this, but honestly, that is total BS. It just leads to more curve fitting. Instead, the real fix for overfitting is simplicity. You need to keep the number of hidden states strictly limited, usually just 3 or 4 regimes at the absolute most. If you give the model too many states to choose from the beginning, the math gets overly complex, it starts chasing noise and completely breaks down on fresh data. Finally, remember that these models are purely data-driven. They are highly fragile to any sudden massive macro shock or structural regime change that wasn't in your historical data. If the economic landscape shifts overnight, the model will be completely blind to it. And the fix here is strict risk management and human intervention, of course. You have to combine the data-driven states of the HMM with some risk filter. If a massive, unprecedented event hits the market, you cannot blindly trust the math. You have to scale down manually your position eventually, or sideline the model until the market stabilizes. Jim Simon did this. And here's the bottom line. HMMs are not a magical crystal ball, of course, but they are sure powerful framework if you apply these fixes. Lock your real-time data so it can't rewrite yesterday's signals. Keep your state simple instead of relying on bullshit optimization tricks, and always back it up with manual risk management. And don't remember, bootstrapping, it will be the best possible way to check and to challenge the robustness of your model, and there is already a lesson here in the channel. So if you have any other doubts, considerations about these HMMs, leave it here in the comments, join our discussion as well in the Discord channel, and of course, hit the like button. So take care, trade safe, and remember, keep things simple. Take care. Ciao, ciao.